Welcome back, ladies and gentlemen. We will now proceed with our next session, Finance, Markets and Society. Let us welcome David Marriage, Global Health of Disruption and Innovation, Asset and Wealth Management, PwC UK, for his introductory remarks.
Good afternoon, everybody. That is a very long title. I think I've already reached the peak of titles there, so I think it's only downhill from there. I hope you all had an enjoyable lunch. I've been told that some of you will fall asleep. My target is apparently 50%, and if that happens, I need to shout the odd word, apparently. So hopefully we can maintain a 50% level and we should all be fine. So I'm here today to talk about capital markets and ESG. There are a number of issues that we're seeing taking shape in the market, but also there's a number of opportunities to close out those issues. So I'm going to start talking about the demand side, and essentially, in many ways, the market's broken. And the market's broken because we're sort of seeing a problem that we've never really seen before as a market, and that's a rapid change in the demand side of the market. So historically, if you like, forever, we've gone to the market as consumers asking for the highest quality product at the lowest price, and as investors, we've gone to the market looking for the highest return at a particular risk level. But what's happening rapidly and at scale is that requirement is changing. So for the first time, we're now seeing people go to the market from a consumer perspective, looking for the highest quality product still, lowest price, but taking into account the impact on the planet and the impact on society when they're making that decision. And investors are coming to the market saying, I still want my financial return at a particular risk level, but I want to protect the planet and society at the same time. And that demand's only growing. I mean, we've seen Anita and Dimitrios and the youth representatives today talk about these issues as things that they care about and things that need to change. But we're also seeing Bloomberg come out with numbers estimating how many people are investing in ESG, so environmental, sustainable and governance type investments. And by 2025, there's an expectation there'll be 50 trillion of assets. That's bigger than the S&P 500 and the FTSE 100 combined, of assets that are essentially deployed to do the right thing in society. And that makes a huge difference. Being able to identify by doing the right thing, you could access these capital pools. But the issue, again, is that actually our demand signal's very weak. As consumers and investors, we've got no real way of communicating to the market what we care about. Do we care more about climate action or diversity? Or do we care about life below water or life on land? And actually, until we're able to create that, there's no real mechanism for the market to respond to, and the ask is weak in terms of the demand side, and the response is therefore also weak. So I suppose in terms of one of the first actions that we need to take as a market is to really understand what that demand side is, and create a mechanism for us as individuals, as consumers, and to a certain extent employees and citizens to communicate what we collectively care about, such that the markets, governments, institutions, etc. can respond. So moving on to the supply side, because it's not just demand that's the issue. Even if we got demand right, we don't really know what the impact is of the things we buy and invest in. And the reason for that is because the market has been designed really to focus on the historical ask of the market. So the historical ask, as I mentioned before, highest return, lowest price, highest quality, lowest price, highest return at a particular risk. But with these new requirements, the market can't cope. So the market essentially works on the finance stuff, so on price and profit. And it works because the supply chain is fully captured in the last invoice of the company that you're looking in. It captures all the costs and prices. That's combined with the revenues to provide a profit and loss and a balance sheet. Those are then formed in the IFRS statements, the International Financial Reporting. So there's standards of the way that we report that information. That's audited, so there's assurance, some external validation of what's going on, and it's shared with the market on a given day. Democratically, everybody has access to that data. For ESG, we don't really understand what's going on in the supply chain, so there's lots of gaps in the data. It's collected at the corporate, but the corporate really hasn't got a framework or standards to create the transparency required. So it creates a sustainability report, which is often qualitative, And those qualitative statements are interpreted by the market. So people like Bloomberg and Arabesque and Sustainalytics and MSCI and the like. And those interpretations can be very different. And so they're also not audited, and they're drip-fed into the market, often to those organisations that can pay. And rather than everybody being able to do that, it's normally 12 to 16,000 stocks. So what we end up with is, whilst this is really important data to get right, there's no real consistency in comparability, and organisations can get into some trouble being accused of greenwashing or new emerging issues coming out of the supply chain, when really all they were trying to do was the right thing. So I think the second action we need to think about is, how do we create that transparency of supply? At the moment, my phone, for example, I don't know whether the cobalt in my phone was mined by a small child that died the next day, or whether it was mined by an adult whose child was in school, who had all the health and safety that they needed and the welfare and healthcare support to make sure that they could mine, they were mining safely. I don't know whether the clothes I wear use loads of water. I don't know the carbon footprint of the food I eat. And until I know that, I can't really make different decisions. I can't really change the way I behave in terms of what I'm buying. But also, I don't know, for example, the diversity of the boards of all of the companies that work on a supply chain of an investment I've made. So again, I've got no real control over my investments, and I can't tell the investments what I care about. But also, I can't make the right decisions necessarily because I haven't got the information I need to do that on the things I'm buying. But what's interesting is, if we are able to create the action of transparency for demand and transparency for supply, what we end up with is quite a compelling shift in the market. We're able to identify the value pool. So if there is 50 trillion of assets that focus on ESG, but we can identify that 90% of us care about climate action, there's a 45 trillion value pool that sits within the market that, as companies move from red in terms of climate action to amber and amber to green, their share price rises because they're accessing these capital pools. And so creating a market where organisations doing the right thing, companies doing the right thing, are rewarded with a share price increase creates a business case change for sustainability. And so rather than the market being the most destructive force in a way in terms of the planet and society, because it doesn't price the environment and it doesn't price society, it potentially becomes the most protective force in society. And so I think, with what we've heard today with the various speakers, it does feel like Cyprus is in a great position to lead the way in this agenda. And with objectives surrounding the Cyprus 2040 starting to be a leading light in this space, would enable you to take great strides towards those goals. So I'll finish there. Thank you very much for your time. And actually, it wasn't anywhere near 50% that fell asleep, so thank you very much. Didn't need to shout any words. And I'll hand over to George. Counsel.
I just want to start by welcoming Nicole Phinopoulou.
Thank you. Can I just introduce you? Thank you. Our next panel discussion on climate change and capital, what the new financial taxonomy on ESG means for the financial sector, and will be moderated by Georgiou, journalist at Bloomberg. Thank you.
Thank you. And I was saying I was just going to start by introducing Nicole Phinopoulou, a lawyer, William Gallagher, lecturer and CFO of Dynamic Counsel, and Ioannis Kaltsas, head of investment team of Greece and Cyprus of European Investment Bank. Welcome all. Nice to see you on this panel where we're going to discuss the climate change and capital and what the new financial taxonomy on ESG means for the financial sector. A financial sector that probably a few years ago might have thought that it would have escaped from the climate change, that air conditioning and nice offices would have spared him from what is going on to the rest of the economy and the rest of the world. But doesn't seem to be so. And the last few years have seen an acceleration of what is going on. I just want to start with asking Nicole, that's grabbing from your experience as a non-executive director of Cyprus Securities and Exchange Commission, and as part of your experience of advising clients on regulatory compliance, what the current initiatives on climate change in the financial sector will mean for the regulator?
Very good and very challenging question to answer. CySEC, the regulator in Cyprus for the stability of the markets and the financial sector, has been involved actively all the last years, and especially from 2018, on the EU Green Deal plan, which is also for the sustainability growth, so how you finance and how you grow and move the capital to support sustainable finance and sustainability, which is how the markets move, as also David noted. And CySEC and Cyprus have been involved and are in the upfront to support the new regulations for sustainable finance. In March 2021, 8th of March, CySEC supported and endorsed what Commission involved, which is the first step for disclosures for investors. The known as Sustainable Disclosure Finance Regulation, which all the asset managers and all the investment firms, they handle money, they handle the investments, all the information they have to give. And also, that means that the market has to look into the ESG and to look how these are embedded and are included in the products they are offering or how they are advised. So, as a regulator, what they're called now, especially after 2021, which is the first step in March, is how this new regulation is endorsed, how it's activated, how it's presented, and how it's followed, which is one minor step in the whole taxonomy, regulation, ecosystem, which the first priority is environment.
We would like to hear from you any recommendations that you have for the Cyprus service sector that would have to deal within this environment.
Actually, it's a very heavy now regulated environment, but I think it's coming for the good because people will manage to sit together. Will also, the industry will come to discuss also with the regulator, and thank you for the opportunity because CySEC was the first regulator to initiate the Hub Innovation, Green FinTech, picking up from where Professor Mascudo said before.
Yeah, very interesting.
So it's good to manage to get the public and the private together, but everybody has to do their own task. So yes, it is a challenge, but I think our market has the services, has the people, have the innovation and the mind to get front and move forward, and also Cyprus has the infrastructure to support everything, the people, the minds. We need goodwill.
Thank you, Nicole.
And we will get there.
Thank you, Nicole. I would like to go now to Mr. Ioannis Kaltsas. As I already said, he's the head of the investment team of Greece and Cyprus for the European Investment Bank, a bank that has been active in Cyprus since the early 80s, over 5 billion euros of investment of loans here in Cyprus. But we just want to hear your thoughts about what it means to be the largest green bonds issuer in the capital market.
Kalispera, Kyrie Georgiou, and it's a pity that I cannot be today with you in beautiful Cyprus, and instead I'm in rainy Luxembourg. And thank you very much for the invitation. To answer your question directly, being the largest green bond issuer institutional means a lot of responsibility, because we have a lot of control and a lot of scrutiny about where the money are going. And we have also a lot of pressure to continuously refine the rules of the game. So as you know, the EU taxonomy, it is an evolving concept. Different rules and different investments become eligible every year, and it's an evolving game as the pressure from investors is mounting.
Can the green bonds issue only in Europe, or you think that
No,
we will see them
The green bonds is something that we see all over the world, and the more and more we have companies that they choose to follow this route. Of course, in an environment that we have historically very low interest rate and for a very long period, the premium for investors is not particularly high to choose between traditional bonds and green bonds. I mean, it would be a good question to see, should the market conditions change, what would be really the appetite of the investors. But the green bonds is something which is associated more and more also from private companies, banks, and institutions that they want to green their profile.
And how the green policies will change EIB lending in Cyprus? What the lenders and the consumers here in Cyprus will need to know about how things are changing?
Climate change is something that is transforming the financial world, is transforming Europe, which chose to be in the leadership of the climate change movement. And it is bound also to transform Cyprus in the way that proceeds with its investments. You know, Mr. Georgiou, EIB is associated all over Europe and also in Cyprus with the big infrastructure projects. Since now 1958, we finance projects in Europe. Most of the large infrastructure projects, the bricks and mortars, most of the large also energy projects or other projects with traditional sources have had the brand of the European Investment Bank. The finance ministers, which are our governors, because we're not a private bank, we're a public bank, took the very brave decision that the European Investment Bank by 2025 will finance 50% of its volume, of its annual volume. It's currently between 60 and 70 billion euros a year, will go towards climate change, as well as that all our projects will be Paris aligned, and also that will discontinue the financing of certain sectors. This is the gas sector, for example. To the disappointment of many of our clients, actually in Cyprus and in Greece, which they felt that, well, Greece and Cyprus did not have the Western European infrastructure, did not have the opportunity, in particular with respect to natural gas, to be at the same level field as other countries, and this could particularly penalize them, especially in the current days that we see an energy crisis and very high oil prices that put pressure on the investor. Having said that, we do believe in this decision because we are a long-term financier. We finance projects with loans of 15, 20, 30 years plus sometimes. So we feel that when we are in 2021, if we give a 30-year loan, we cannot finance an asset that after 30 years in 2050, if Europe is serious about its vision of becoming a carbon-free economy, carbon-neutral economy, I'm sorry, that we put such an asset out in the market. So this is not also economically correct. So for Cyprus, we will have to although we come later in the game in some of the sectors, however, there are wonderful opportunities with respect to their natural resources, with respect to better environmental management for climate, both mitigation and adaptation. So the investment opportunities are there, and I think for a part of the world that is has a dowry of abundant natural resources in terms of sun and wind on and offshore, that there's a lot of opportunities over there.
Thank you, Mr. Kaltsas. Now going to Bill Gallagher. Bill, we would like to make sense about how we, first of all, I need to explain why is this, because Bill previously was working for UBS, Credit Suisse, Lehman Brothers, and so we want to make a sense about how this green taxonomy will affect the market and how the market sees this green taxonomy.
It was interesting listening to David, and he had started off his presentation saying the market is broken. And I don't think the market is broken per se. I would actually rather say that we're kind of feeling around in the dark a little bit. We're searching for standards. We're searching for auditability. We're also searching for words and consistency. And I think the green taxonomy is actually good in the sense it's a search for a common language and common standards, which will lend to transparency, will lend to greater understanding, and it will begin to tell the investment banks and the investors and the issuers what they need to strive to. It gives us a goal. Right now, the capital markets have an alphabet soup of standards to apply to any particular loan or bond. You know, it can be issued by or issued under standards approved by the ICMA, the International Capital Markets Association, or it can be issued by the Loan Markets Association, the lending group out of London, and as well as the high yield associations and many others. And so anything that pushes convergence, pushes standardization, will allow greater comparability, transparency, and understanding. And that always facilitates deeper, more efficient and liquid markets.
Are you concerned that we are setting goals for executives and there will be incentive to play with the numbers?
Well, that's yes, I guess, again, pointing to David and just starting off with auditors, one of the issues you have is that I sit on a board of a company, and we are in the midst of a debate about how we actually hold executives accountable for reaching environmental KPIs. And I know there's going to be a discussion later on corporate governance, but obviously part of the disclosure that investors will want to see is how are companies actually taking these goals that they're setting seriously. If it's simply a penalty of, I guess the penalties on bonds now range from 1 to 10 basis points, and frankly, that's a difference in margin that can be captured by a variability in 1 week's window of issuance. It doesn't seem like very much. But once they begin to know that the executives are vested in their pay packet, then it becomes much more interesting. But you point to an issue about how do we know? I mean, the problem is we don't have FASB standards out there comparable. I know we have SASB seeking, again, looking for the dark to create something that's auditable. It's I guess we're not there yet, but again, having the EU's taxonomy actually and the whole movement towards kind of standardization of green bonds will also carry with it an ability to create standards that can be audited, and therefore you can hold companies and executives to account.
From the market perspective, how do you make money out of green bonds?
The same way you make money out of out of regular bonds is issuance, assisting companies. Obviously, the more interesting aspect is, less in terms of issuing bonds for the EIB. They're going to be an easy issuer to sell. The margins that they allow the market are actually pretty thin. So the more interesting part is going to be on the kind of lower rated instruments, and which is traditionally, I think, one of the more profitable sectors for banks. And there, I think the volumes will be lesser, but I think the impacts will be more. There's been a huge wave of money. I think I was reading that actually outside of green bonds, there's been an outflow in money this year in terms of collective investment funds in fixed income, whereas an amount even greater than that has actually gone into green bonds. So it's obviously a theme, but it's it goes to the heart of what banks do, which is help people raise funds.
And to narrow down to Cyprus,
Yes.
What does it mean for a market like Cyprus and for the service sector here, this in green transition? Yeah.
I mean, my experience here has shown this. We've got some very flexible, experienced professional service providers who are hopefully able to advise their clients in terms of taking advantage of perhaps assets that they already have. One of the aspects of certainly the non-financial disclosure, which I guess we're going to have greater reporting coming into effect in 2023, is frankly, actually companies do begin to realize that they actually have pretty good controls on environmental topics, and actually it will. I think the transition to that will be good in terms of public companies. But I think as was pointed out, Cyprus is an island with a whole host of assets that can be turned into I guess green energy infrastructure and otherwise environmentally friendly industries. And I think it holds out a lot of future if Cyprus can take advantage of perhaps some lower cost of financing, which comes about through the popularity of investing in green bonds.
Thank you, Bill. Nicole, coming back to you, and from your experience in the Cyprus and Securities and Exchange Commission, are we doing enough as regulators, as a state, to deal with this?
We are doing enough, but okay, always there's room for more, as in anything. Yeah. Though I think, especially for the sustainable finance and the green technology, we're supporting green bonds, we're supporting AIB, because as Cyprus, we're part of all the European state, EBA, ESMA. But the thing is that it's not only as regulator, this is what I'm saying, the regulator is there. Then it's the industry to get involved and to be supported. Also the same, the industry, and I agree with William and Ioannis that they need to have the eager to go through. As Cyprus, of course, we're a small state, but we have other things that we can support. We may not have the emissions, or we may not have what is the target for climate, but we have other things that we can support, and at least on the green side. But if the green bonds come out, we are working on the standard also in the European level, but AIB is a very good example for green bond standards. You can support in other things. You can support in the structure, you can support with people, with brains, with innovation, with technology. So yes, I believe we can do that as Cyprus. And as the regulator. I'm not saying as the CISEC, because there's many regulators, and also the ministry that was there before for the innovation. It's a work for all.
It's a work for all.
It's work for all. It's a combination.
Mr. Kaltsas, from your banking experience, what do you have to say to the Cypriot banks? What do they need to be careful?
Well, we have a very good cooperation with almost all Cypriot banks. And I think what currently Cyprus is lacking, but not only Cyprus, is there's an abundance of cheap money. The issue is not cheap money at this point. There is a lot of appetite also for risk. What we miss is very good projects from the public sector that to move fast, because the process and procedures sometimes they delay this, and to get the advantage of the fact that we have cheap money and there is also some flexibility in the fiscal rules currently in Europe. And also, I think we also miss the commitment very often of private sector investors to be engaged in the long term. You know, green investments does not mean often quick profit, and it can be profitable, but it means that somebody has to put a lot of work, a lot of thought, take some risks, and the money are there. So I think, I think the problem is more on the supply side of the projects rather than the financing from banks or the third other institutions like funds, EIB, etc.
Bill, taking from the point that in green economy sometimes there is no quick profit, what does it mean for the Wall Street and the City of London, and how the markets make sense of no quick profit?
Well, I have to say it's good that we have banks, and they'll tend to be public sector banks that are able to take a long-term view. One of the pressures that I guess certainly the large banks are under these days is actually optimization of return on equity, which becomes difficult given the risk weightings and the amount of capital required to be held against certain projects. You know, given the pressures on profits, the type of infrastructure assets that are certainly generate renewables are difficult for those to be financed off the balance sheet of banks. However, we are obviously as intermediaries able to. I think they are an opportunity to sell. There are a pool of investors who are becoming more willing to take the longer term aspect of assets, you know, and they'll look forward to a good return in 15, 20 years' time, and they can understand that. So I think in terms of the banks themselves, they're probably not the natural home for this, but I think other private investors that we do reach out to are probably better suited.
And coming to you, Nicole, for a concluding comment, and give us some sense of the future. How about your clients and what the future will be with climate change and capital?
I agree with both, and Ioannis and William here, because you have to see the supply chain, you have to see the long term, and then you have to also, as an investor, also as a service provider, to explain to investors that there's not the easy money or the fast, but when you invest, you have to be some longer than the 3 or 5 years, but you have to see what's going on. I mean, the information presented, the disclosures, the environmental, the ESG criteria that they imply, so they will know where they invest. So this is, as service provider, also it's another, for the service industry, the challenge, how they present products, and loans also are products, to their clients, and also if they have a good project to come forward and to support it. It's not always, it's a win-win situation, maybe take a little bit longer now, but there's a lot of opportunity out there and the money are there. It's just, we need patience.
Yeah. Mr. Kaltsas, what is the future on climate change and capital, and how EIB sees the future?
This is not a fashion, climate change financing. We are here for a long term, and things will become more and more sophisticated. Something we notice that a lot of companies, there are even traditional companies like oil companies, in their effort to quickly diversify their revenue streams, they are taking currently quite a few risks, and they invest heavily in disruptive technologies. Sometimes we see projects that sound like science fiction. So we do believe that over the next decade, we're going to have new technologies, disruptive technologies that might change the whole landscape of climate change technology and financing. And I think this is something that we should all have in the back of our mind to be optimistic about the future.
Thank you. Bill, destructive technologies will be the bet to invest in the markets?
Yes, I mean it's always a picking the right disruptive technology is always a good thing to do, but it's always hard to know in advance. Although taking the reverse view, not investing in terms of the disruption, I think has been seen by the markets generally, and so I think we had a very good case earlier this year looking at what happened to Exxon's board, where obviously I think shareholders realized that the Exxon, which obviously one of the legacy petroleum producers, wasn't actually investing enough in alternative technologies. And so the shareholders realized their own capital was actually at risk because Exxon was not investing in disruptive technologies. So I think it's kind of interesting to see that the markets are recognizing that you actually do need to invest, whether it's a separate company or a behemoth like Exxon. I think you do, companies to survive do need to see over the horizon and begin to explore what comes next.
And since we have a few more minutes for the final round, Nicole, here in Cyprus, do we have companies that they see the horizon? You are heavily involved in the market, and you are very experienced working with these people.
We do have. Actually, some came up, I will be honest, on this the last 5-6 years, because they did the risk management, which is correct, to have good risk assessors and risk management, to combine it with their internal strategy as to have sustainable business for the future, including climate change, including environment. I see companies coming up slowly, but they're more into it. But at the end of it, if they want to survive, they have to adapt. And it's not about environment and climate because it's a change, it's there. So you need very good risk assessment, risk managers, and good learners, I would say. It's not about just ticking the box. There's nothing like this anymore. We're waiting a lot of things. Things are coming up also from, we said before, disclosure, regulation, to give information to clients is something that Exxon was something that we saw in, it was a mini success of the minority shareholders, that they saw where the capital was to flow and what they want also to invest. Also, you have to see the changes of people and their mindset. Some people, not some people, most of the people, they think about the environment. They think what they're buying. They're thinking the climate change. They think other things. So that's how, it's a base risk assessment. What you're selling, who you're selling it, what you want out of it, and what you're willing. It's also a matter of will as well. But I think we'll get there. But we have examples. I won't say we don't have. We have some, but we have.
Thank you, Nicole.
In Cyprus.
Mr. Kaltsas, what you would like to see next time you're in Cyprus from the public and private sector? Your clients.
In terms of climate change, you're asking?
Yeah.
Yeah,
What do
yes.
you like to see? Yeah.
Yes, I think there are a lot of opportunities in Cyprus, both from the public and the private sector, which I also mentioned earlier. I think also climate change is an opportunity, if you want, for Cyprus to diversify from traditional sectors of its economy, which is actually banking, our sector, and tourism. So what I would like would be for the private sector to take all the advantages that are there in terms of energy efficiency, for example. In our calculations, energy efficiency investments could be the most profitable investments that a lot of entrepreneurs could do in their businesses, but also in their houses. and also for the public sector to really think about climate mitigation, because in climate adaptation, I'm sorry, because Cyprus is a very beautiful island, but I'm afraid that it will suffer a lot in the next few years from extreme phenomena of climate change. So we don't have a lot of time to waste there.
Thank you very much. Bill, the market, how you see places like Cyprus and the Mediterranean? What are your thoughts about how the market will see these opportunities for the future?
Well, in terms of Cyprus, and I'll group it together with Greece, although I see Cyprus as, in terms of infrastructure, at least more advanced, and I think they're viewed as very good opportunities. I mean, you are seeing an avalanche of. I mean, I think the political situation in Greece has obviously changed and has begun to attract a lot of investment. I think for Cyprus, it may be, I think, some of the infrastructure projects that are being spoken of, and one of them, for example, connecting Cyprus to the European grid and to the Israeli grid, would give it, certainty in terms of energy supply, or at least smooth it out, and allow it perhaps actually, perhaps even to become a net exporter if things work out well in terms of at least renewable energy. That may be a way off, but I think there's a view certainly that Cyprus is a very flexible, innovative place, and I think in my relatively short time here, I've actually been impressed by the mindset, which is, and so frankly, Cyprus's main advantage is actually its people. So I look forward to getting to know them better.
Thank you all for the discussion. It's been a real pleasure, and I came out wiser about how the climate change will affect the capital and the financial sector, and I think, I hope that the audience also has also come with this idea as well. Thank you very much.
Thank you.
Thank you. Thank you very much.